Let's talk about public sector accounting, specifically Ipsas 32. This standard is the rulebook for how governments account for massive projects like highways, hospitals, and airports. These projects are often too big for governments to handle alone, so they partner with private companies in what's called a service concession arrangement. Ipsas 32 ensures transparency and accountability, showing how governments record new assets and long-term commitments. Without it, comparing government finances or understanding their true obligations would be nearly impossible. We'll break down what these arrangements are, how assets get recorded, and the two main ways governments account for their side of the deal. By the end, you'll see how this boring accounting standard shapes the world around us. So, what is a service concession arrangement? It's a long-term contract where a government, the grantor, partners with a private company, the operator. The operator builds or upgrades public infrastructure, like a toll bridge or hospital, and then operates it for decades. The infrastructure provides a public service, and the government controls what services are provided, to whom, and at what price. At the end of the contract, the government gets the asset back. Real-world examples include toll roads, hospitals, airports, and water plants. The private operator is a custodian, not the owner. The government sets the rules and retains ultimate control. This structure lets governments use private expertise and funding to deliver essential services faster. That's why accounting for these deals correctly is so important. Here's where the accounting magic happens. If the government controls the asset, it must record it on its books, even if a private company built it. The asset is recognized at fair value, usually the construction cost. For example, if BuildCo constructs a $20 million library, the government adds a $20 million asset to its balance sheet. This is done with a journal entry, debit the asset account, and credit either a liability or deferred revenue, depending on how the operator is paid. This step formally acknowledges the public's new asset. The credit side of the entry sets up the next step, how the government pays for the asset. The model used depends on whether the government pays the operator directly or lets them collect from the public. Let's see how each model works. The financial liability model applies when the government must pay the operator, no matter what. The government owes cash, usually in installments over many years, regardless of how many people use the service. This creates a financial liability, or debt, on the government's books. For our $20 million library, the government debits the asset and credits a financial liability for $20 million. As payments are made, the liability decreases and interest expense is recognized. Each payment is split between reducing the debt and paying interest. Over time, the liability is paid off, and the government owns the asset outright. This model shows the true long-term debt created by these projects. The grant of a right model is used when the government doesn't pay the operator directly. Instead, the operator earns revenue by charging the public. Think toll roads. The government gives the operator the right to collect user fees for a set period. The government still records the asset at fair value, but instead of a liability, it credits deferred revenue. Deferred revenue represents the value of the right the operator received. Each year, a portion of deferred revenue is recognized as income, matching the period the operator runs the service. For a $500 million toll road over 40 years, the government recognizes $12.5 million in revenue annually. This model reflects the government's gradual earning of the asset as it gives up the right to collect fees. It's a different risk. The operator, not the government, bears the demand risk. Once the asset is on the books, it must be depreciated over its useful life. Depreciation spreads the cost of the asset over time, showing the true annual cost of providing the service. For a $20 million library with a 50-year life, that's $400,000 in depreciation expense each year. Major upgrades, like a new wing, are added to the asset's value, capitalized. The way the upgrade is paid for determines if it's a new liability or more deferred revenue. This keeps the asset's value accurate and up-to-date. Proper depreciation and capitalization ensure the government's books reflect the real state of public resources. It's not just about building, it's about maintaining and improving over decades. This long-term view is essential for accountability. Ipsas 32 is about control and transparency in public-private partnerships. It ensures governments record assets and obligations from these deals, giving a true picture of public finances. The standard distinguishes between direct government payments, creating debt, and granting operators the right to charge the public, creating deferred revenue. Depreciation and upgrades keep the asset's value accurate over time. Ipsas 32 forces a long-term perspective, showing the full life cycle and commitments of public infrastructure. It's a complex standard, but its goal is simple, honest, clear reporting of how our communities are built and maintained. And that's why it matters to all of us.